Now, let's take a look at these. Basic concept behind this trade, and I know that most understand this who've done these before. As a company is going to have earnings coming up, the fear, uncertainty, and the doubt represented by the earnings announcement increases the implied volatility in the options. Um, what I mean by that, if you're a person who is writing options, and remember the options writers are typically the ones who are driving where the price is at. They're the ones who are saying, I'm creating the availability of these options, and this is the price I'm willing to sell you this option at. So those are the people who are driving the price. As they get closer and closer to an earnings announcement, they stand a risk of holding an option, basically selling an option to somebody that could go radically against them over the earnings announcement. Now, a lot of people are going to be, shifting around positions and protecting themselves, obviously, but these guys don't want to take that risk. So what they do is, as they get closer and closer to the earnings announcement, they raise their prices. They increase the cost of the option that you want to buy. That in turn means that the implied volatility in the option series has gone up. Now let's take a quick look at that. Hey John, if you don't mind muting for a second, you can hear you scuffling in
I just
the
did mute.
There. Thanks. I'm not trying to kick you off.
On.
Yeah, feel free to jump in at any time. I'm not trying to kick you off. I just had
I've got a new trade out on Scripps, a bull put. Just put it on. ESRX.
ESRX, okay. Okay. This is KMX. Now, as I was talking about a few minutes ago, as the earnings announcement approaches, the earnings announcement approaches, the implied volatility in general tends to go up. So what you're looking at right here is, oh, and by the way, for anybody who'd like to follow along, that is the website that you can use. That's the link you can use to get to this analysis that I've got right here. For anybody who hasn't seen this before, this is an analysis that I did to basically capture money on trades, capture money on trades going into earnings announcements. I went through the historical earnings announcements that the companies had, all the way back, in this case, Q1 2008 through Q1 2012, analyzed all of those, and I looked at how the implied volatility on the options changed as you got closer and closer to the earnings announcement. Each one of these individual squiggly lines represents one instance in the past of an earnings announcement. I basically said that the earnings announcement was on this point in time, the zero line, and I went back 25 business days, took a sample of the implied volatility, and then I measured how that implied volatility changed as it came into the earnings. In the case of KMX, on average, and this is across all of these different earnings events in the past, on average the implied volatility went up 21.32%. That's on average. That's the black line. The key point to this is that a lot of times the implied volatility moved up quite a bit in the last 7 to 10 business days, trading days, before the earnings announcement happened. Now, how do we trade this? Well, we want to create a trade that's long vega, that's long implied volatility, and we want to create a trade that's relatively safe to take. Okay, Jennifer, the number of days shown on the calendar are trading days. So that has to be actual trading days. So it does become a bit of a pain in the butt because you have to subtract out weekends. On this spreadsheet, which I'll have Doug post up after the class, it's not a fancy spreadsheet. It's just, just very basic. It actually calculates out trading days for you. That formula right there will get you the number of trading days between now and the earnings announcement itself. So once again, the key is that we've got this increase in implied volatility. Now, this doesn't tell us anything about anything else going on in the stock. It doesn't tell us that the price of the stock is moving. Doesn't tell us that doesn't really tell us anything except for the implied volatility going up. Now, what do we want to do to take advantage of that? The most basic trade that we can use to take advantage of that, and there are other trades that we could do, but the most basic one is to do a basic straddle or strangle. You take it by a long call and a long put. If it's a straddle, the long call and the long put are typically at the same price, normally the at the money strike. If it's a strangle, you take and you move out a little bit. You buy a long call that's a little bit out of the money and a long put that's a little bit out of the money also. By going further out of the money, you reduce the cost of the trade and you actually leverage up the trade a little bit. But there are some things that are negative about that too. So we want to watch that. Straddle is the most conservative version of this trade. The strangles, as you get further and further out, are a little bit more aggressive, but also they have some. You need greater price movements for them to work out better. Well, I'll show you that in just a second. Now, the worst thing about a straddle or a strangle, they're very, very safe trades. In some ways, they're very conservative trades, except for the fact that they have a lot of theta erosion. Now, you're holding two long positions, a long call and a long put. Every day you hold on to that, you're going to lose money. It's just a natural fact. The value of those options goes down. So we want to try to engineer a situation where we lose the least amount of money, and we also want to take and make sure that this implied volatility as it goes up is going to cover our costs on losing the money because of theta. John, did you have something?
Doug, John.
Yes.
I'm going to be off for about 45 minutes, 45 minutes. Bye.
Okay. We'll see you back. So the goal is engineer a trade that takes advantage of the increase in implied volatility, offsets our theta erosion, which basically gives us what we'd call a free ride in a trade. Now, we can actually have a trade that has very little risk, not no risk. There's still plenty of risks out there, but very little risk relative to the trade itself, and gives us the opportunity to take advantage of big price movements to make some serious money. We've done a great job in this in the past. Google has been a huge winner for us many, many times. A lot of these other stocks have been, good winners for us. And right now, we've actually got a unique situation where this could be a very, very good season for this. The reason for that is that implied volatility is already low. If you've already got implied volatility low, the second biggest risk in this trade, which is the implied volatility going down instead of going up like you expect it, is really mitigated. That risk becomes very small because if there's a channel, there's a bottom to implied volatility. Now, nothing's saying that the market can't be irrational and go even lower than that, but it's unlikely. So this earnings season could theoretically be a very good one for us. KMX is one of the trades that I'm looking at. Now, KMX has its earnings announcement coming up on the 5th of April. So we don't have many days. We have 7 trading days before this thing expires. So we're basically trading from here to here, which is not a bad place to be. That's actually a really nice piece of the slope. We can do a short-term trade, and we have a couple of options as to how we set this trade up. So let's take an actual look at KMX. Now, actually, before we dive into that, I do want to show off a couple of the little pieces on this website itself. This website needs some updating. I've got some new plan changes, but it does have a couple of things that are fairly handy. One is the trade analysis. Now, I told you that the simplest way, most straightforward way of taking advantage of this trade was a straddle. You basically buy an at-the-money put and call, and use that to capture the implied volatility as it goes up. So I did an analysis that basically simulated that. It went back in time, and for every earnings announcement, it created a simulated at-the-money put and call. Started with one 25 days out, and then exited 24 days out. Started with another one 25 days out, exited 21 days, 20 days, 19 days, all the way right up to the earnings announcement itself. These balls, these dots, give you an idea of what the return would be if you had entered a trade at this point and then exited at any point along the line. So in this particular, let's see, let's use this one right here. This trade was entered 20 days before the earnings announcement and exited the day before the earnings announcement itself. And it had an average return across all of the earnings announcements of 20%, or excuse me, 29% return. Now this is the least leveraged of the trades, the straddle. And the green dots represent positive average returns. The red dots show negative average returns. So in this case, if you had entered in, let's see, 23 days, exited 19 days, on average you would have lost 12%. Now that could have been, a bunch of small loss, or it could have been one big loss. I don't know. Now, what I don't want people doing is using this chart as a absolute perfect, this is the exact point that we want to do this. I want people to look at it and say, this is an area of entry that looks like a good mix. I want to see lots of possible wins here. Because there is nothing perfect about this. When you're analyzing the past, you're analyzing events that have already happened, and you don't have much context. This is just showing you a very, very generalization, a big generalization of it. But what it does tell you is it gives you a sense of what time periods in general work better. So the fact that there's a whole nice area of green here is a positive thing for me to see that. So just some thoughts on that. One more, company profile. Now, what the company profile does is it shows you all of the information relative to all of the other stocks that I analyzed. There's roughly 800 stocks in this database that I've gone through and analyzed. And every one of them has some ratios and some information. Like, when I do the simulated trades, the back testing, I get a ratio of winning trades, which is basically any trade that made more than zero, to losing trades, any trade that lost money. So my ratio of winners to losers is right here. In this case, on this particular stock, 50% of the trades were winners. I also know what the average winning percentage is. I know that on average, my winners are 28.87% return. On average, my losers are 16.20% return, or negative 16% return. So my win return versus loss return is just a ratio is 1.72. My winners tend to be 1.72 times the size of my losers, and I win roughly 50% of the time. I take those numbers and these two charts over here, I compare KMX, CarMax, to every other stock that I analyzed in the database. And you can see that KMX comes out pretty well. The further to the right, the better. And you can see this distribution of samples. It shows you, this right here is the peak, where most of the largest number of stocks that I analyzed ended up in this peak. To the right of this is better. The further you get to the right, the better the analysis was. Same thing over here, average winner to average loser. The average was somewhere slightly above 1.4 right around 1.4, 1.5. KMX with a 1.72 was significantly better than the average. It was on the far right-hand side. Just some ways to take a look at these. Just some thoughts to that particular stock. Now we'll take a look at a couple others here in just a second, but okay. All right, let me pull this off. Let's take a look at KMX right now. Okay, Mike. Okay, actually, Dennis and Mike. First of all, the number of trades on KMX. Yes, the trades analyzed of 5,400 was actually trades on KMX, not on all 800. This database is, God, it's on average right now we have somewhere around 5,000 trades analyzed per symbol across 800 stocks. So it analyzed 4 million separate trades across the entire database. KMX represents 5,400 of those. Now that 4 million is a rough number, but it's pretty accurate. Now, Mike, to clarify, if a stock reports earnings just after the close, it's that counts as day zero. If it's before the if it's before the open, you have to make a slight adjustment and go back one day. There's so many variables in here that I didn't nail down every single thing. You still have to use a little bit of judgment when you're looking at this. One of the things that you don't want to do on this particular trade, we have another trade to take advantage of this, but on this trade, you do not want to be holding a long straddle or strangle after the earnings announcement, because the implied volatility is going to drop like crazy. You can see it going from here down to here. In this particular case, it's up 21.32% at its peak. The day after, or the moments, literally the moments after the earnings announcement happens, the implied volatility drops to negative 3% relative to where it started. So you can see that that's really a big drop. You need to avoid that. This tool, this website that I'm giving you, is just something to help you on the trade. It doesn't tell you everything. You still need to work out the details. So Mike, did that answer your question? And actually, Dennis, same question. Okay. Now, KMX. And by the way, we're going to get into Google here in just a second. Google's another very good one. KMX has had a pretty good price movement recently. The implied volatility is starting to go up. Now, by the way, ignore this V-shaped drop down here. That was just TradeStation screwing up the data. The implied volatility did not go to zero on that day. We're just starting to see the implied volatility going up. It's probably going to go up significantly higher. You could see this was probably one of the earnings announcements before. You can see how the implied volatility does go up leading into their earnings announcements. Then boom. So we want to catch that. Now, a couple of basic things. Implied volatility is going to go up the most in the front month or the expirations that are closest to the earnings event. So in this case, the Aprils are going to get affected by the implied volatility the most. May is going to get affected by implied volatility a little less. So we need to make some judgment calls on this one. If we use May expiration, we're going to have less of theta decay because each day is going to represent less decay on the actual, the actual options prices. But we're also going to get less benefit from the implied volatility going up. And we're going to get less delta for the price movement. So the trade will actually be slower using the Mays and probably doesn't have as much profit potential using the Mays. But it's also safer because we're less likely to lose some money. If we do the Aprils, we have a fairly high amount of theta erosion. Now, I've got an analysis worksheet here, and it does a lot of the basics. So let's just fill this out real quick, and let's take a look at these two different trades. None of this is automated, so sorry. We just need to basically put in the data. 34 point, current price on KMX is 34.60. Expiration date. First thing I'm going to do is use the April expiration. So 4/21/2012. I'm going to do I'm going to do a straddle on this one first. I just want to basically get a sense of where we stand on this trade from the point of view of a straddle. So that means that I'm going to use the at the money strike. In this case, that's 35. It's a toss-up as to whether or not you would want to use the 34s or the 35s. In fact, a good way of maybe doing this trade would be doing the 34 puts and the 35 calls. But right now I'm just going to do a straight straddle using the 35 strikes on the April expiration. Now, I'm going to assume that I can get into the 35 call for $1.10, which is the bid-ask midpoint. The 35 put is $1.50. Now, in this particular analysis, we need to get some of the Greeks in here because the Greeks are going to be important. They're going to tell us how quickly this trade is going to erode over the not-too-distant future, how the price of this trade is going to go down, and where our risks stand. So those are going to be important things. So let's do the, whoops, I got these backwards, sorry. $1.50, $1.10. Okay, so let's get some of the Greeks in here. So the 35 strike, it's got a delta of negative 53.1 cents. It's got an implied volatility of 36.12. It's got a theta of 2.6 cents, 0.026. And it's got a vega of 0.035, 3.5 cents. Okay, so there's the put side. Call side is got a delta of 46.9, an implied volatility of 36.25, a theta of 2.7 cents, 0.027, and a vega of 3.5 cents. Okay, why are these important? For one basic reason. They're going to tell us what our risks are and what we've got to basically overcome over the next couple of days as we deal with this trade. This is a trade where we know pretty clearly how long we're going to be in it, and that allows us to figure out how much money are we going to lose from theta erosion, how much exposure to risk are we going to have from the implied volatility going up and down, and then with a little bit of luck, we'll get some price movement and make some good profit on this. Now, earnings date on this particular trade is the 5th. Okay, a website I highly recommend that you keep up is earnings.com. And watch for changes on this thing, because earnings dates don't necessarily stay completely stable. They can shift around. A couple of things to notice here. In general, KMX has a tendency to announce its earnings before the market opens. So this means that we actually need to be out of this trade by the end of the day on the 4th. So let's go take a look at that. Actually, let's double check that that's not a weekend. Okay. April 4th at 4 o'clock is when we have to be out of this trade, because if we hold this overnight to the 5th and the earnings comes out, they hit relatively on target, the value of our trade is going to go down radically, because the implied volatility is going to disappear in this thing. So exit date on this trade, 4/4/2012. Now, here's where we need to make some judgment calls. We have an earnings announcement coming up. We know that that's going to affect the implied volatility. But there's also a risk. The risk is that for some reason, against all our analysis or judgment, the implied volatility does not go up. If it doesn't go up, what do we think the bottom is? What do we think the floor is for the implied volatility? Now, I'm not taking this trade because I think that the implied volatility is going to drop. I seriously do think that the implied volatility will go up. There's a very strong trend for that. But if I'm wrong, I want to kind of know what are my support levels for implied volatility. So to get that, all we do is make an estimate. Basically what I'm doing is I'm looking at the history of the implied volatility, the blue line here. Now, it's very rarely gone below 32%, 32.5%, once in a while, but very rarely. And we also have the earnings announcement coming up here, which is going to help, basically increase that. It's going to help support that up. So I just want to make a rational judgment call about if my assumptions about the trade go bad, how bad could this trade go? Well, one of the things driving it's implied volatility. I'm going to make a judgment call here that I don't believe that the implied volatility between now and the earnings announcement would drop below 32.5%. So I need to put this in here, 32.5. And remember, we're getting very close to the earnings announcement, so there's going to be a lot of pressure for that implied volatility to go up. All right. I've got the basics. We're analyzing this as the most basic trade around this we can do, which is a at-the-money straddle using the April expiration. Now, from all the numbers that we entered in over here, we know a couple of things. It's going to cost us roughly $2.60, plus or minus 5, maybe 10 cents either direction to get into this trade. So we know basically what our cost basis is. That's going to be our, it's going to determine our margin. This is a debit trade, so the margin is very, very simple to work out. The net delta on this particular trade is negative 6.2 cents. Now, I like to do these as delta neutral as possible. You want to try to get this number right here as close to 0 as you can. The reason for that is that it centers the trade, and if the price starts moving in either direction, you can actually start make money immediately. In this particular case, by having a delta of 6.2 cents, I'm going to have the stock move up a little bit more before the straddle starts making money. In fact, it's going to go down slightly as the price goes up, just for a brief amount of time. It's going to go down slightly before it starts making money. On the other hand, negative delta in this case makes it more sensitive in our favor to the stock price going down. You can actually tune this. If you think that the stock price is going in a direction, you can actually run this thing with a specific delta, a negative delta to take advantage of falling prices, positive delta to take advantage of rising prices. A delta of 6 cents, 6.2 cents, is not horrible. If I saw a 15, maybe 20 cent delta, I'd be worried. I'd be worried that I wasn't getting this well balanced. But overall, I'm not too worried about this one. Now, average implied volatility on this trade is 36.19%. No problem there. The theta. Now, this right here is how much of the trade are we going to lose on a daily basis for holding this trade. Every day that we hold this, the theta on the trade is going to be 2%. So basically, we're going to lose 2% a day for every day we hold this thing. We have to overcome that. We have to either get price movement or implied volatility movement that offsets this loss, or that's going to give us a loss. In fact, that's one of the driving factors of this analysis in this trade right now. The Vega percentage. For every 1% increase in implied volatility, we're going to get basically a 2.7% increase in the value of it. So if implied volatility went up from 36.19% to 37.19%, we're going to make 2.7% profit. And then the next one, we're going to make another 2.7, and so on and so on. Now, this also is a risk factor, because if the implied volatility drops, the value of the trade is going to drop by that amount too. So we want to keep an eye out for that. Overall, we've got a fairly short period of time for this trade. By the way, the calculated, based on our implied volatility floor estimate, our possible implied volatility drop is 3.69%. One thing I really like about this particular earnings season is implied volatility across the market is so low. It is amazingly low. VIX of 15, currently a VIX of 15. Everything is right down at the bottom of its range of implied volatility. It means there's plenty of room for things to go up. Very, very good possibilities. So in the past, last quarter, we were dealing with a situation where the market had been crazy for a long time, implied volatility was dropping. And it made it very difficult for these trades to be successful, because we were fighting this flow of implied volatility going down. This season, we don't have that problem. So we're basically at a floor. We've got a nice safe trade. You know, we absolutely can lose some money on this, but do I expect to lose a lot of money? Probably not. Now, the key is, how much can we make? And to make a lot of money on this trade, we need one of two things to happen. One, the implied volatility goes way up in a short period of time, or two, the price moves a lot. Now, luckily in this case, we don't need it to move a huge, huge amount. If the price were to start going down by $1, we would make basically 6.2 cents on this thing, the first dollar. But it's going to accelerate pretty quickly after that. Next dollar, we're going to be making probably around 30 cents. Dollar after that, another 50 cents. We'll be making money pretty quickly at that point. So a couple dollars movement on KMX down, and this thing is going to be making money fairly quickly. It's also going to drive the implied volatility up, which is also going to make money on this trade. So let's look at this from an analysis point of view. We are going to be out of this trade by the 4th, the evening before the earnings announcement. Very important on KMX we get out then. Theta decay between now and then is 14.27%. So we're losing 14% of this trade if the implied volatility does not change and if the price does not change. So between now and then, if IV goes just flat and the price goes flat, we're going to lose 14%. Implied volatility goes up or the price moves, we're actually going to be making money. So it's going to offset that loss. Now, Vega risk, this is important. This is looking at what would happen if the implied volatility dropped from 36% down to our floor, our estimate of 32.5%. That rate there is an important number. If that were to happen, then we would lose 9.92%. So that's a second risk. Those are the two risks in this trade. Those are the two things that could make this trade lose money. Now, overall, 24% risk on this trade is not bad, considering that if KMX moves down by $2, we're actually going to be making quite a bit of money on this trade. Just off the top of my head, would probably make somewhere in the area of about 36 to 40 cents on a $2.60 trade. And if the implied volatility goes up, these are really rough numbers. Please don't take this as a strict analysis. But let's say we made 40 cents divided by $2.60. That's 15% profit in and of itself. Now, $2.60 plus 40 cents. This is assuming we had roughly a $2 drop in price in KMX. Now, KMX certainly can have a $2 drop. But the bigger thing on that is going to be the fact that if we have a $2 drop, not only do we get that 40 cents increase because of delta, but the value of our trade is now $3, and we're probably going to see somewhere close to about a 10% increase in implied volatility because of that. The implied volatility will go up from 36 up to probably about 46. Let's just do, yeah, I mean, historically the implied volatility has jumped quite a bit right before earnings announcements. I mean, this one right here was the implied volatility of 56. I'm only saying we're going up to 46 in this one. 71. I mean, implied volatility moves a lot on this. So the value of our trade went up to $3 from just price movement, and then we get, remember we get, let me see, 2.69% return per 1% increase of implied volatility. So if we get 10%, that means we're making 27% on top of that. $3 times 1.27. $3.81. So that's what the trade would hypothetically be worth at this point. Now there's going to be some theta erosion in there. We're going to be losing some of that. So okay. Once again, this is really just off-the-cuff analysis. But the resulting trade after theta erosion, the increase from implied volatility, and an increase from a price movement gives us a trade value of $3.23. Our original cost, $2.60. We basically made a 25% profit on this. Not a home run, but not bad either. For a trade that I don't think carries a huge amount of risk. By the way, the theta decay is a hard fact. You're going to get it. The vega risk, I don't believe, is going to be a major part of this. I think that the implied volatility is going to go up. This only comes into play if the implied volatility goes down. So I think that overall it's a pretty decent trade.